Okay, everybody, welcome to the Which Strategy and When Primer course. This is going to be our probably most sophisticated and complex and important mini class perhaps ever. And as a result, because there's so many moving parts, there's been so many questions about it. I want to get everybody on the same page to understanding, knowing what this is and what it's not. I don't want to oversell. I don't want to undersell. We're trying to give the best representation of what it is possible. And when I say sell, I mean, I haven't even sold any mini classes ever. Once in a while, I'll explain what it is. And if you like it, take it. If not, don't. It's they're going to sell regardless. So I'm not money hungry, and really, I'm much happier with the smaller crowd that's dedicated than a larger crowd and more money. It's less headaches and a happier existence to me. And so people who don't sign up don't really bother me. And perhaps that makes me a lousy businessman, but I'm at the stage of my life. I just want to be around successful people and enjoy what I do. So that being said, let's get started on what tonight is. Again, it's the primer course for Which Strategy and When. And as a matter of fact, probably 2, 3 times a week, we have an example that I pick because the students want to learn it or do it. And I'll do it in pod class, even if it's not what I would consider the ideal situation, ideal conditions and circumstances, and that I would probably pick a different strategy. And yesterday and the day before, we had a perfect example of it getting into Sophie trade on Monday for Tuesday's earnings. And I mentioned to everyone, this isn't exactly the best strategy for the situation, but I've been hounded to play the name Sophie, which I don't really follow, and to do a ratio spread in there, which I love ratio spreads under the right circumstance, but this isn't it. But I'll do it anyways. And maybe there'll be a little opportunity and things, there'll be a little serendipity where if things work out right, we can turn that ratio spread into an unbalanced condor, an unbalanced butterfly, a BWB, or something else that would make a great lesson. Now, it didn't work out that way, but it's a great example to illustrate what this class is about. So we'll go through a whole bunch of stuff, and I'm going to go at a relatively quick pace because we got a lot of material to cover. The room is completely full, from my understanding. So um, I think of last night we had 27 openings left where we could fit people in, and now it's completely full, even though I'm not seeing the actual number of people. I'm just seeing the names and the list and everything, but I don't have a total count. But I know in the past we booked the room completely, and some people were a little upset that they couldn't get in. They had to listen to the recording, but you snooze, you lose. So let's get going. And again, this is about the Which Strategy and When mini class that we're having November 16th, which is a Saturday, and the 23rd. I'm actually breaking it up over 2 weeks instead of doing it back to back. In the past, I've done many classes where I'll have it on a Saturday and a Sunday. It's brutal for everyone. It eats up somebody's entire weekend. They're exhausted by the end of it because most of us haven't been in school in a long time. So 2 full days of classroom study is tiring. And it doesn't allow me to make adjustments that much. In other words, on the first day of class, if there's a whole different route and avenue people want to take that I think, hey, you know what? I didn't even think about it, but this is a great idea. I should maybe expand on it a little bit this way. I really don't even have time to make slides for that class. a whole bunch of questions will come in. I don't have time to make slides for that. And in the past, we've had bonus classes, like a third day, to accommodate all those things. By doing it this way, where it's one Saturday and then the next Saturday, we can go a little bit more exhaustively, cover a little bit more material because I don't have to worry about frying everyone's brains, including myself, out. And if there's a whole bunch of questions that are coming in after people have all the material and can absorb it, and before the next class, I have a full week to make up slides, which take a long time if I go into a lot of detail and I want to do them correctly. So we're having it over 2 different weekends, and I think it's going to be a great thing. Now the session is being recorded, so if you miss anything, don't worry about it. You can go back and it works just like a VCR. You can go and fast forward to wherever you want to go, but it's pretty basic. And the whole mini class is going to be relatively basic. I think there's going to be some material in there that nobody knows. And it'll be in different spots for different people. But it doesn't matter. This is one of those mini classes where if you're missing and don't understand 5% of the class because you never learned this strategy, it's not a big deal. And as a matter of fact, we're going to be giving out as part of the bonus that we always give out with this class 10 of the past pod classes on the more complicated, less common strategies. So if you don't know what, for example, an unbalanced condor is or a risk reversal is, you'll get a pod class on that so that you can not have a hole. We'll fill up all those holes. That being said, let's go through the disclaimer that just says we're giving out education, not advice, and we're not going to be doing any trades tonight, so I can scroll through this real fast. And by participating in tonight's class, you are agreeing to all the disclaimers. That being said, my favorite holiday is tomorrow, so happy Halloween to everybody, and happy birthday, Tracy. It's my daughter's birthday tomorrow. So that being said, today is where we're at. And you can see on this calendar that the 16th and the 23rd are the dates of the class. That gives me a whole week to get new material in should great questions come in from the first class. I can include it in the second class. Don't forget we have the Fed the week before, and we have daylight savings time and the election the week before. So it's going to be a chaotic trading week. I know the last 2 weeks have been unbelievably boring trading. That's going to change, and it's going to start changing probably on Monday. So let's go through which strategy and when and how this whole class came about. Why am I having this class? First, no one else has had this class. No one else probably will have this class. It is a brutal, brutal, brutal class from my perspective to condense down to a spreadsheet. To condense everything down to one little cheat sheet. If you ever done a cheat sheet in school, and I'll admit, okay, I did. Okay, when I had to memorize 15 different physics equations or 30 different chemistry equations, I've used a cheat sheet in the past. The funny thing is, by making the cheat sheet, I memorized all the stuff and I never even used the cheat sheet because writing it down in the little tiny microscopic writing embedded it in my brain and I never needed the cheat sheet. But the great thing about this class is you're going to get a cheat sheet that's going to cover all the different strategies of when to use them under what conditions. And The cool thing is, right now, volatility is at 20%. That's going to eliminate a lot of different strategies you would be using right now because you're going to be buying premium. It makes itself conducive to others. Now, I've done a watered down version of this before, but it didn't have a lot of variables. It was a incorporated in just a little section of a whole nother class. This one is expanded in a whole class in itself, and it's going to take skew and a whole bunch of other things into consideration that we've never done before. Because of all the possible variables, nobody wants to even tackle this. It's just too much work. And for people who are usually in this industry, I don't know if they don't have the background, the work ethic, the combination of both, but it's just never been tackled. I've done it before in a easier version, and now it's the expanded version. Why else have this class? Okay. I'm telling you right now, there's no gimmicky and sales component of this class. This is not going to be a fun class like alchemy, where everybody's looking at it. And there was some like moments where I don't care how sophisticated you are in trading, people are like, wow, that's cool. I did not know this. It's almost magical how I can take this, just slide it over a little bit and get something else. And the responses in the windows and stuff were just cool, great, awesome. I love this. Probably not going to get too much of that here. This is going to be a little bit of work. Okay. And I'm not going to try to oversell it. It's going to be fun. Okay. This is, everybody wants to win the Olympics, but nobody wants to do the push ups. Now, this is going to be more of a class of push ups. It's going to be a lot of work. We're going to go through a lot of material, pretty much every single strategy I've used in the last 10 years in pod class is going to be covered in 2 days and the conditions in which we would use them. It's a lot of material. Okay. Alchemy was easy to sell. It was a cool, fun class. This, I'm not even going to try to sell. I'm selling broccoli and carrots. You need them. They're healthy for you. But everybody, when they're hungry, they're going to walk by the sweet shop and get the banana split instead. That's cool too. Now, why are we having this class? It's going to need a little bit of elbow grease in terms of brain power. It's recorded, so if you need a break and walk away for 10 minutes, just write it down and stuff. But there's a lot of variables associated with options trading. Deltas, gammas, thetas, vegas, and rhos. We also have other considerations when we're trying to pick a trade. Each of these Greeks make different strategies more favorable or less favorable under certain conditions and volatility levels and trends. But we also have a whole bunch of other variables to consider, like market direction, strike selection, expirations to choose from. This burns people out. There's too many moving parts to make this a fun class. This is a lot of studying class. This is the stuff that literally took me years to figure out on the trading floor. And I had to go about it the hard way. There was no class. I had to go and touch the stove, get a flesh wound, get a burn. I had a lot of flesh wounds learning this stuff. And I'm not a real fast learner. I'm pretty stubborn. So if I did a trade and it blew up in my face, I was pretty certain it was because I bought volatility too high at the given time and volatility collapsed. But more experimenting is needed to be 100% certain. And so sometimes I touch the stove 2 or 3 times before I realized never touch this stove. So you're getting what took me years and years and years to figure out. Okay. Now, the good thing about this whole thing is this spreadsheet is a beast. I've got it all over my walls right now as I'm still like tweaking it. But ideally, what's going to happen is you take the current market conditions, volatility, skew, direction, follow the arrows in, and it's going to narrow it down to the best strategies and eliminate the ones that would probably not work out for you. Now, anything's possible. I've seen people do the dumbest things in the world and make money on it. But we're talking about probabilities, not flukes, not black swan events, not Six Sigma events. So the spreadsheet is going to keep you out of trouble, ideally, when making a decision. Hey, this market's doing this. It's going down fast. Volatility is blowing up. I kind of want to buy a call or call spread. Where's skew at? Where's the VIX at? You follow the column, say, well, you know what, in this particular situation, a risk reversal would probably be better because volatility is going to work against you. Or this would, or that would. And that's the purpose of this class. And let me give you an example, just to make it a little bit more tangible, a little bit more practical, especially for the people who are in pod class. It's going to be a lot more relevant, but you don't need to be in the pod class to benefit from the strategy example that we're about to go through right now. Okay, on Monday and yesterday, we had on one example of failing to choose the correct strategy for the current market conditions. And I'll explain why we did it and everything else. It was somewhat deliberate. It was not the worst strategy, but it was the suboptimal strategy to do in Sophie Bank during an earnings period. But based on all the information coming to me, all the questions, all the requests, and I get a lot of requests. I feel like, well, for you older guys, anyone on the wrong side of 50, I feel like Casey Kasem. Because I'm just getting requests after requests after requests. And a lot of times I almost feel bad about it because it sounds like I'm discouraging people and saying now is not the right time to do it. And because of this and this, and people just got to take my word for it. And most people are really good sports about it, but some people are like, well, I want to do it anyways. And I just refuse to get you in a habit of having a favorite strategy that works 80% of the time, but you want it to work 100% of the time. So you're going to force it into a situation where it doesn't really work. So let's go through Sophie, which was done deliberately. It was not a disaster going in. It was probably what I would consider a little bit less than ideal. Probably a lot less than ideal. Probably a lot less than average. But it wasn't one that I knew was putting our head on the chopping block, one that was playing with dynamite and short fuses. I had a suspicion that even though it was not the right time and the right strategy for this particular trade, if we were fast, we could still wiggle out. And because the risk was small, I didn't mind doing it. And I thought it'd be a great example to explain to people why this class is so important, because some people are just not quite understanding it. So let's go through it. And let's talk about Sophie, which I know very little about. And it's a bank, and it's very popular, and it's been in the news, and I'm getting a lot of people requesting I do it. Part of the reason is probably because it's a $10 stock, and people love the little tiny stocks. Part of the reason is it had a giant run up. It was at 7.5, ran up to 11, 20. in the last 20 trading days last month. It was going to have earnings. It has big option premiums. There was a lot of stuff that people are attracted to, especially with the smaller accounts. And so I finally acquiesced and said, okay, let's do it. And I could tell everybody was going to be bullish on this trade because it's being hyped like crazy. It's almost like one of these, meme stocks like GameStop that like people just think are going to be the next one that goes from 10 to 100. And the media is trying to, do their part in getting people involved in it. I mean, they're talking about it being, making everybody a selfie millionaire. And, you know, others are saying take the plunge and buy Sophie, buy a dip, take a trip. Um, you know, this is nothing but positive headlines, and then the analysts, they're going to get involved when they see people, wanting to trade something. They're going to get involved because they want to be popular too. And so they start raising their price target from 12 to 13, from 8 to 9, etc. And all these things take off. So I was getting a whole bunch of students' questions about this, knowing that the stock was going to have earnings on Tuesday right before the opening. I'm going to give you a handful of them, and you'll see why I acquiesced. Okay. One person, I really want to play earnings in a small but volatile stock like Sophie. Does a ratio make sense? Please do one of my trades for a change. He he he. Okay. This individual apparently feels like I neglect all their stock selections, and I apologize for it. It's nothing personal. I usually go off of just what the majority of people pick. Another person, Sophia's earnings and has been on a tear there. Okay. Earnings are going to be great. So can we get long it? That was the common theme. Everybody thought earnings was going to get long or was going to be great. And guess what? Earnings were great. Earnings were stupid great. We've been doing a lot of unbalanced spreads. Can we do a ratio and hedge later, making a BWB or unbalanced spread? This one kind of warmed the cockles in my heart. This was the one that kind of really pushed me into doing it because the person had not only a trade he wanted to do, but he wanted to take that trade and morph it into something he's never done before. And it's a natural progression from what we've done. And I thought it'd be a great lesson if it worked out. Then another one. It's been years since we did a ratio spread. I don't think it's been that long. I think we did one not too long ago, maybe 6 months ago, but okay. I'm not going to argue. I remember the last one we did to set up for a big move. It made a fortune. Let's do one in earnings names. Well, sometimes you can. And this last one, let me address this. Once in a while, depending on volatility and how they're pricing the options for that particular name in this particular earnings cycle, and how big the expected move is, and how much you're willing to risk in terms of the distance between your short and long option, you can set up a ratio spread. Under most circumstances, however, a ratio spread is less than ideal because you're not buying premium. You're not buying premium at a time where the stock is having earnings and the premium is going to be twice as high. Volatility is going to be twice as high as normal. This is when you want to be selling premium, not buying it. Sophie was a little bit of an exception. Yes, volatility was high, crazy high, and we'll see that in a moment. But because the distance between the strikes was so tight, we sold the 11 and a half and bought the 11 that was already in the money. And our break evens were so narrow. Then I said, this is not a great trade. I don't want to be buying premium, but if I'm going to be doing it, if I'm going to be buying premium via a ratio in a stock going into earnings, I guess this is the least deadly of any that I've seen in a long time. So there were others. This is just a small sample of the kind of stuff I get, and specifically with ratios and Sophie. So going into earnings, we see this 20-day Sophie chart. Okay, the stock ran from 7.5 up to 11.20 in 20 days leading up to earnings. That's a $3.70 move on a $7.50 stock. It's almost a 50% increase in 20 trading days, guys. And I understand the world's got you convinced the stock is going to do well. And it's probably going to do well because it's a small company that's growing at a fast pace. It's not mature yet, like Microsoft or Apple. So having extraordinary earnings is not really difficult in a fast growing company. But when everybody was so bullish and we had this kind of run up, I just said, you know what? I know everyone's bullish. They want to get long Sophie. I know nothing about this stock other than a couple of headlines, but I want to be bearish it. I don't see stocks with this kind of bullish sentiment, this many maniacs snorting the share price off of their trading desk, earnings meeting or even exceeding, and then the stock still runs higher from there. Usually everybody who was going to buy has already bought, and that's why the stock's up 50% in 20 days. So even if they have exceptional earnings, the stock will maybe stay flat because everybody who wants to buy has already bought. And if they even just meet earnings, everyone who bought is going to be disappointed. They don't see the stock going higher. They're going to start selling the stock, which is going to cause the stock to go down, which is then going to have people panicking and selling their stock, which causes the stock go down more. And we see the stock go down even with good earnings. And I know anyone who's been around for more than 6 months has seen this. Stocks have phenomenal earnings, the market goes lower. Stocks have unbelievably good earnings, and the stock goes lower. What's that about? Then I seen, and you'll see the opposite, where stocks have horrendous earnings, but it goes up. Why? Because everybody knew the earnings were going to be bad, so they got shorter out. And now that the earnings are out, the bad news has passed us. What's left to hurt the stock? And it goes up. So we placed a trade right there on Monday, right at the close. And this is all, like I said, this is all I know about Sophie. One, the stock is up almost 50% in 20 days. Two, I do not want to buy option premium. This is a big warning. I don't want to buy option premium. When the November options for the November 1st expiration are 131%, then the November 8th expiration is 106, 107%. And you can see 40 days out, December 6th expiration at the bottom, it goes down to 67%. That's pretty much, I'm guessing, where the average volatility is. So around 67% is probably the normal volatility out there. And it's double that because of earnings. I don't want to buy volatility at 131% and then watch it get cut in half the next day. What else do I know? Today, day later, we see that volatility has collapsed. It went from 131 in November 1 expiration down to 85 tonight. And the November 8th expiration went from 106, 107 down to 72, 73. Volatility got smacked, which is a very predictable thing. I also know I don't want to get long deltas. If the whole world's long deltas, I don't want to be on the side of the Titanic that everybody's leaning on and forcing it over. I'll be at the top. And the last thing I knew, students wanted to do a ratio in there, and so I acquiesced. Now, here's the trade we did. Stock closed at about 11.20, and I sold the 11.5, 11 put ratio. And for those who are familiar with ratio spreads, we know that the break even is going to be the next strike down, which is 10, plus the premiums. Well, this is me closing it out. Plus or minus the premiums, which is 32 cents. So right there is our break even. Now, again, it was a very tight ratio and it started in the money. Okay, the market closed right here. So if we went up a little bit after earnings, like everybody suspected, I was going to lose 32 cents, but I could probably wiggle out real fast. And if we went down big, I'd be near the break evens. And by big, I'm talking $1, which, on an $11 stock is a big move, but it did move almost $4 in 20 days. So in terms of ratio spreads, the valley is relatively tight of only $0.50 between strikes. Again, I wasn't really loving this trade. The which strategy and when spreadsheet would tell you to stay away from this trade. But I decided to do it anyways because I'm pretty good at knowing when to wiggle. Now, earnings came out. Now, look what happened after earnings came out. Total revenue was up 30% from the previous quarter. Crazy. Revenue increased 102% year over year. Everybody's right. Earnings were going to be fantastic. Interest income of $431 million was up 25%. This thing's firing on all cylinders. And it's got 9.4 million customers now. That's up 35% from a year ago. I mean, I've never been involved in a company like that. I mean, that's like, if I worked there, I'd probably forgo a paycheck in lieu of getting stock options. This thing is doing great. Okay, now what happens after earnings? As I suspected, I'm not always right, but this one was kind of a layup. I told everyone I'm not getting long it. I know you want to get long it, but if you want to learn the ratio, I'll learn the ratio getting shorted. Here it is. And look, we dropped precipitously after earnings. Why? They had fantastic earnings. In the pre-market, when earnings came out, you saw the stock jump. Now, the majority of people, majority of retail, you, me, you know, Joe Public, is not trading in the pre-markets. They're waiting for the actual trading hours, the normal trading hours. As soon as the bell rang, they came in. In the pre-markets, it jumped up. And then once the bell rang, it just fell hard. And it closed again at 11, I think 11:20, 11:12, 11:20, and opened up as low as 970. Now that's a pretty big move. Now, right after it did that, it bounced real fast and got back to about 10. And it hung out at 10 much of the day, but it was still $1, $1.20 drop. On an $11 stock, that's a pretty big drop. Now, I just told everybody, let's wiggle out of it. I looked at it for a little bit. I wanted it like as well, let me back up. The initial goal was to take the existing trade and then morph it into something like a BWB, an unbalanced condor, or a ratio spread that had a tail for, to bring in money, et cetera, et cetera. There's a whole different litany of things we could have done with it. I didn't see anything intelligent. So I said, let's just close it down because it's probably going to lose money. Volatility's falling hard. We're long volatility. Just puke it out. We paid 32 cents for it. I'm closing it out and collecting 32 cents. And we learned our lesson, which was the original goal, anyways. Don't touch this stove. Well, sometimes you got to touch the stove and see that it's a little bit hot so that you don't do it again. Okay, now there we get it a little bit up close. The earnings came out, it spiked up. It went from 11.20 to 11.99, and then before the bell even opened, it fell. And you can see how fast it fell once the bell rang. In the first minute of trading, we fell from 1070 down to 1010. That's 60 cents on this, on this stock. That's a big drop. And then the next couple minutes, you had everybody who was long, who thought the stock was going to infinity, vomiting out, for a lack of a better word, but it was a lot of volume there. You can see this can only be described as a vomit. Get me out at any price. Trade. Before I lose money, get me out. Okay. Now, we waited about an hour because I was waiting for things to calm down. There was a lot of different things I was looking at to play with this as a way of just having some fun and learning to morph from one type of strategy to another, especially in volatile situations. There was nothing there. So I just said, I'm closing it down. I was short 2 contracts at 11 and a half. I'm going to buy those back. And I was long 4 contracts at 11 puts. I'm going to sell those out. I'm going to take in a 32-cent credit, break even, and then close the trade right about there. which is good because after that we started running higher again, and I would not have had a second chance. Okay, because of the volatility crunch right now, as the close today, I'd have to pay 13 cents to close the trade. Remember, I bought the spread for a 32-cent debit, then closed it out for a 32-cent credit. But the original purchase was a 32-cent debit. Now, if I wanted to close it out, I'd have to pay 13 cents. So think about that. If I had to pay 32 cents to get in, right, and now pay another 13 cents to get out, that's a 45-cent debit on something that is a $0.50 wide. The distance between 11 and a half and 11 is 50 cents wide. It's a brutal collapse of volatility that causes a brutal collapse of profit potential. Had this trade been $5 wide instead of 50 cents wide, meaning it was like 115 strike versus the 110 strike, you're looking at 450 to close out a $5 wide spread. Now, we wiggled out and we broke even. I was watching this very carefully of how much I could push our luck, and I just told everyone, get out. I mean, normally I send an image. I cut, paste, write up an update, send it out. That takes like 5 minutes. I didn't even want to wait 5 minutes. I just said, hey, everybody, on this ratio and Sophie, we paid 32 cents. I'm getting out right here for a 32-cent credit. I'm reversing it because I didn't want to even delay things. Now, what's the lesson from this? Anyone go to parochial schools other than me? We all had that same nun. I don't know how. She even looks the same. No matter what school you went to, if you went to a parochial school, I went to parochial school in the Chicago suburbs. But all my friends that I met through trading and stuff, guy I know grew up in Maryland. He said, I went to parochial school and I had that nun. We all had the ruler. I've got a scar to this day on my hand from a ruler. Guess what? I've got a lot of scars from trading too. Why? Because I picked the wrong strategy at the wrong time. This class is about having you avoid that. What did I learn from this? What? Nothing. I was expecting this. I thought we were fortunate to break even. I was expecting to lose a couple cents if we were fast. I thought we'd only make money if we got very lucky and the stock fell like $2. And I was expecting to lose maybe a nickel, and considering it, hey, 2 contracts, we lose 5 cents, we lose $10. I think everybody will pay $10 to never make this mistake again. So we learned from this trade that I picked the correct direction, but we picked the wrong strategy. And I knew this ahead of time, but I felt we could wiggle, so I did it. Now, how do I avoid getting my fingers smacked? That's what this class is all about. We're going to go through a million different strategies. Now, here's where the class is answering people's questions. We have a huge amount of students asking for more detail about the class. I'm working on more questions and answers. Now, there's question and answers on our website that have already been answered, and anybody can go and read them. I have more really good questions I'm in the process of answering about what the class is and what the class is not. We're going to cover some of that now and in greater detail in the write up, probably Friday morning, because I'm going into a lot of detail. I don't want to just spit it out overnight real fast, one sentence answers. But what is it? Well, first, we're going to cover all the strategies we've been doing in probably for the last 5 years. It's a lot of them. Now, we can't possibly cover every one of these strategies in great detail, obviously, in 2 days, with criteria and a million examples of how to get in, how to get out, what am I looking for, etc. This is focusing on the strategies I covered there, but more specifically, we're not going into criteria on each specific strategy. Instead, we're going to take a step back and say, is it even a candidate? VIX is at 20. Skew is tight. The trend is higher. There is news or there is not news during its expiration that could move this, etc. Checklists. Then this would be a viable strategy, or this is a strategy I would reject and move on. Then from there, the onus of responsibility is on you to understand the strategy. Now, that's going to get some pushback. People are like, well, I didn't learn what the razzle dazzle is. Okay, that's a fair statement. We could spend 2 days on just learning the right way to do the razzle dazzle. How are we going to get the other 40 strategies in? Knowing when to do the razzle dazzle and when not to is just as important as how to do it. For those who don't know a couple of strategies, it's not a big deal. I don't expect everybody here to know every single strategy. Some people are not going to know the Billy Baru. Some people are not going to know jelly rolls. Not a big deal. Even if you only know 6 strategies, knowing when to use those and when not to is going to dramatically improve your trading. Because I guarantee you, even floor traders use the wrong strategy at certain times. And I've told the story before. I used to work with a guy named Terry. He was on the trading floor for 17 years. He's a great, great trader. As a matter of fact, this is how good he is. In 17 years on the Chicago Board Options Exchange, he never had a losing month. 17 years, not a losing month. Think about that, people. 17 years, he never lost money in a given month. That's what, over 200 months without a losing month. I can't make that statement. I had several losing months. We had a different trading style. He was very conservative. I was very aggressive. um, so there was days where I took big pain. When I knew it was the right thing to do and the odds were in my favor, I didn't mind putting on a lot of risk. Terry was very risk averse. He cleaned things up as soon as he could. I let things go a lot longer. Doesn't mean I'm right. He's wrong. I had a lot bigger positive days than he's had positive years. I've made more in a day than he's made in his best year. But he slept better than me. He knew his personality And he conformed to it. He didn't want to be Evel Knievel. He wanted to sleep at night knowing that if he took tomorrow off because he didn't feel good, he wasn't going to have a disastrous day. He wanted to know when he got into the exchange in the morning and saw that we were at war or the Fed changed rates or something, he wasn't going to have a painful day. Now, after 17 years on the trading floor, without a losing month, you can bet and be assured he knew a lot of trading strategies and when to use them and when not to. But there was a time when, right after the dot-com bubble burst, and we fell for 18 months, he and I were together in a room at the dead bottom. And when we bounced, I said, that's it, get long, but do not buy a naked option. Volatility's too high, don't buy a naked option. If you buy a spread, make it a wide spread. Better off doing risk reversals. He went out and just bought a naked option because he thought we were going to go up big. And we did. We went up 1,000 points in a week. Which back then, it's not like 1,000 points now, right? Think about where the Dow was at in 2008. It was like a 2/3 lower. It'd be like us going up 3,000 points in a week now. He had to ride the market that full equivalent of 3,000 points right now to break even, because even though he was long deltas, the volatility getting crushed on his longs was offsetting the gains he was making long deltas. In other words, he was taking one step forward, one step back. The market would go up, so he'd make, we'll call it 100 deltas on, or $100 on deltas. Okay, but when volatility came in a point, he lost $100 on volatility. So his naked option was unchanged at the end of the day. And I still use it as an example because it doesn't hurt his feelings. He's done a million great trades. He knows he messed up. I give you guys see a lot of examples of where I do a bad trade. You know, um, now here's a guy who was in a room right next to me, and I sort of always, and this is going to sound arrogant. I don't want to give that impression, but whatever room I've been in with traders, um, I've sort of been the wise old man that people took direction from, even when I was a kid, and they were twice my age. Um, and so, like everybody in the room, other than Terry, blindly followed me because they weren't as smart as Terry. Um, they knew they didn't know everything, and that I knew more than them, and that I was giving them probably good advice, and so they did it. And they were doing buying call spreads, they were selling out of put spreads. They mostly all made a lot of money. Um, Terry went off in his own little direction. I don't know if he thought he was going to leg into a call spread better. I never asked because I knew he was in pain. So I didn't want to ask a question that would imply you did something wrong. Let me fix you. That's the last thing people want when they know they're making a mistake. They know they made a mistake. They don't want to be reminded that they made a mistake. And we didn't circle back until he was hedged. But he broke even when everybody else was making money. Why? He picked the wrong strategy at the wrong time. Plain and simple. He bought a call spread or a naked call in probably the most violent move higher we've ever had in his career. And it took him a whole week just to get back to break even. happens. Okay. When I was first starting out, we had a war going on. I knew Persian Gulf War Part 1, when the war was going to start. I think the whole world kind of had an idea. CNN wasn't what it is now. It was a pretty good station back then, and everybody was watching. And they gave reasonable arguments for when the war was going to start. And I said, well, it's not going to start today because it's daylight there, but it'll start tomorrow, around 6, 7 o'clock Chicago time, because it'll be nighttime there. And it started almost exactly when they said. I came in with ratio back spreads on, in the OEX, where I sold one call and bought two, one strike higher, for even or even a credit. We went through all those strikes dramatically, and I couldn't break even for the longest time because volatility remained high even though we were going up. I picked the wrong strategy. I was new. And I didn't think volatility would stay as puffed up as it did if we bounced. But we were bouncing so rapidly, and there was a war going on, that volatility didn't come in enough for those ratio spreads to collapse. So when I was younger, I was picking the wrong strategy at the wrong time. I had to get smacked and touch the stove, just like Terry touched the stove. And I know everyone listening here has touched the wrong stove at the wrong time. And that's what this class is avoiding. So what this class is not going to be a criteria on the ratio spread. Even though you're going to pretty much get much of the criteria implied. When you look at the sheet and says if volatility is this level or higher, you don't want to do this trade. Anybody with a little bit of common sense will realize, well, this must be a strategy that benefits from low volatility. And there'll be a little footnote here and there to explain stuff in detail. The spreadsheet's going to come with footnotes for further explanation. So, like when you see this, let me show you that again. When you see this right here, a little snapshot of the spreadsheet, that the yes or no is good enough in some cases. In other cases, it'll say depends. And then there'll be a footnote. It may be a good trade. It may not be a good trade. It depends on expiration. Only do it with more than 3 weeks or less than 3 weeks. Just because some things are going to need a little bit more description and specifics. Okay? What it is not is very important too. Again, we can't go into every little minutia detail on all these different strategies, but it's going to tell you when to use which one when. You'll learn each strategy as it does apply to the worksheet that we'll be using. So you're going to get more of an understanding than you probably would get from reading just a remedial book on the strategy. In other words, if you bought a book on call spreads, I think just the little bit of nugget you get from this class on call spreads is going to be more than you'll get from a book on call spreads. That doesn't always go into, hey, this is going to be a negative when you get skew this way or volatility this way. Never brought up in books. Okay. Now, Glenda and I had a miscalculation. I don't even know if there's going to be seats available by the time the class starts. We're selling out of this thing fast. I think people understand that I'm really juiced about this. And I really think that this is the most important class we'll have in years. Some people are going to disagree and say, no, the collars are going to be more important because I plan on doing a lot of those. Fine. But if you're an option trader, this is going to be more important than alchemy or anything else. So we don't even have to lower the price, but we did make an error between Glenda and myself. And whenever we make an error, we always stick with whatever's going to benefit the student the most. And answer your question, Butch, yes, 100%. So in this case, Glenda and I had a miscommunication of when the trades, or when the sales and everything went on and what price and everything else. She quoted someone at one price, I quoted a different price, so that we don't affect anyone negatively. And I think I'm not sure whose fault it is. I'm not going to pass blame. It's probably mine. I've been having a lot going on. Getting ready for classes, doing a lot with collars and stuff. I may have been distracted and not paid attention. It might be my fault. But as a result, the price of the class should be higher. It should be $8.99. I quoted $8.49. I thought it was still going at $8.49. So she's extending the flash sale until November 1st at $8.49. And we're going to extend the early bird rate until November 3rd. If you don't get in for the flash sale, which is what, Thursday or Friday? By Friday, you got to enroll by Friday to get $8.49. After that, you got to enroll by like Monday to get $8.99. Then it's going to go $9.99. We're always going to, when there's a miscommunication, we're going to keep the price the most affordable and beneficial to the student. This is one of those situations. Apologize for the confusion. Again, it's probably my fault. She's pretty detail orientated. I know those people who talk to her a lot know she's more on top of the administrative stuff than I am. So just letting you know, Glenda wanted me to let you know that if you see the prices different than they should have been, it's not a sale thing. It's just we're compensating for any potential confusion. So it actually benefits you. You can still get if you missed the flash sale, you still got another day or two. Okay. Yeah, Glenda is great. You're right, Butch. She's awesome. The smartest business decision I ever make is who I hire. I've had hit and misses, but, Glenda's probably the best hire I've ever made. Paulo's pretty good too, but he's behind the scenes. You don't see him too much. That being said, the flash sale ended. We're bringing it back for 2 more days just to be fair. And the early bird is being extended beyond that for another 2 days. That's going to give you guys plenty of time to get in at the low price. We're not trying to sell more seats, with these gimmicks and stuff. I don't believe in gimmicks. People see through gimmicks. This is an honest mistake on my part. Okay. Now, that being said, people are asking what's included in this class. That's a great question. I was a little bit vague in making the flyers and sending it out to the art people who do it. And, I knew what was in it, but I wasn't descriptive enough. But it's going to be obviously 2 full days of education, all the recordings, all the slides like we always do. Here's where it needs some explanation. Some people never even heard of this. Some people are vague about it. We're throwing in 10 pot class recordings. Now, some people thought 10 pot classes going forward. No, 10 pot class recordings. Why? I am picking 10 pot classes of the remedial strategy of stuff that newer people may not have seen. New people may not know what a jelly roll is. So we'll have one class on the jelly roll because it's going to be on the sheets. And I don't want you sitting in class going, I have no idea what a jelly roll is, but I'm paying for this class where I'm expected to know the jelly roll. One class on the 10 most likely strategies that people may or may not have had experience with, depending on when they were coming into pot. You're also going to get a spreadsheet so you can replicate what strategy when, like I do pretty much in my head every single day. There's a flow chart from experience and everything else. Some of it I have to even think about. It's just natural, like vowels on the 30, and I'm like, I immediately go to certain strategies, knowing that the other ones like will be buying premium, and I don't want to buy premium. So you'll be going through the same process through this spreadsheet that I go through. Eventually, looking at this sheet long enough will be like the greatest, fastest learning experience ever. It took me years to learn the stuff on this sheet. You'll probably just by going through it for a few months will maybe not have it memorized, but see a trend there where like everything's sort of coming together. Like I said, I've taught this class before as a little section of a bigger class, just a remedial portion of it. And I've had a couple people say, when I saw this spreadsheet, the light bulb went on in trading. I realized I've been using my favorite strategy, a screwdriver, all the time, but I can't use a screwdriver to nail in a nail sometimes. But I've been trying it because that's my favorite tool. So I'll just either back off or learn to use a hammer. Um, if needed, we'll have a bonus session. And there's one thing I'm not going to tell anyone about because it's not 100%, but I got a big surprise. It's 99.9% certain that we're going to include it, but this alone, well, the 10 pot classes for people, some people will cost as much money as taking this course. So they're sort of getting the course free if they bought the 10 pot classes. But the surprise alone is going to be worth the price of the course. And then you get the course. That being said, one last thing. Because this is such a beast of a class, Glenda is giving out certificates of completion to anybody who wants one. You got to let us know. So, because in the past we just sent them out to people and had old addresses and stuff. But once it's done, if you want a certificate of completion, this is just one I made up. It's not our actual ones that we have. But you're more than welcome. We'll send you one out and I'll sign it, and it'll come in the mail so it doesn't get dinged or anything. And because this is probably going to be worth it. I mean, this is like the most intense information filled class I've ever taught. This is more intense than what I teach, when I'm at Northwestern for 2 days. Again, 2 full days of education. I'm not limiting it to that. If we need a third class, we'll do a third class. But I think the benefit of moving the classes 1 week apart allows people, when the class starts, they're going to get the spreadsheet and they'll be able to look it over, and they'll have a week of looking it over in one full class under their belt, that any question they have possibly will come to their mind and be like, you know what, I'm a little vague on this. That gives me plenty of time before the next class to get everything ready. Whereas in the past, there's some people that would have questions, and I'd say, God, this is just one of those questions that not only lends itself better to slides, slides is a requisite to the understanding of it, because there's an option chain I have to pull up, and then I have to show you some math that if I just say it verbally or write it with my mouth, you'll never understand it. We better have a bonus class. So you're going to get 10 pot classes. I'm picking those. If for some reason, and I don't want this abused, but if of those 10 classes, there's one other one that you want that's not in those 10 classes, I'm sure we always in the past said, you know what, Scott brought up the Billy Baru. I don't know what that is. It's not part of the 10 classes. We'll always be willing to give you. an extra recording at no cost. Okay, guys, you have a great night. Again, more questions and answers will be coming. If you have any other questions about this class, please let us know. I'd like to get everyone's questions answered by Friday, so I can focus again more on the slides. Peace out, people. Have a great night. Thank you.